This is the Trading Psychology Podcast. This is VP, creator of No Nonsense Forex and author of the book No Nonsense Forex Trading Psychology. And with me, as always, is Rob Reinhold.
Hey everybody, this is Rob from Maverick Trading and Maverick Currencies. Maverick is a prop firm where we let people come in and use our capital to trade. We enter into a profit split agreement with them to where the trader keeps 70 to 80% of the profits. We keep the rest.
And on that note, I have traded for several prop firms, and through sponsorships and offers and things like that, I've gotten to know really well. And I could honestly go 20, 30 minutes telling people how different Maverick is from your average prop firm. But Rob, if you can do that in like 30 to 60 seconds, let everybody know what separates you guys from everybody else.
First thing I want to say is, look, there's great prop firms out there. Every one of them is different. And every single person out there is different as well. We actually have interviews with the people that are looking to come aboard Maverick. And there's times where we say, hey, look, you're not the right fit for us. We are looking for a very specific type of trader. You may want to go to some other places because we're not quite the right fit. The way we work is that we start our traders out with a pretty good significant amount of capital. In Forex, 10K, in stock and options, 25K. And then we adjust them from there all the way up to six figures pretty quickly. As I said, there's lots of good firms out there. We may not be the right pick for everybody, but we really want to have people hit the ground running.
And this leads in really well to episode 12, because I want to ask you out there, not you, Rob, but the listeners, what is your end game with all of this? Do you want to trade your own money? Do you want to trade another person's money? Do you want to show other people how to trade a certain way? Do you want to be a prop trader? There's a lot of ways. A lot of people thought the only way to succeed in the Forex game was to trade their own money. And then I hit them with the reality that said, hey, you probably don't have enough money to make that happen. And it's going to be a long time until you do. So let's focus on a more of a step-by-step approach. So I had always recommended a step-by-step approach that can lead to a host of different outcomes, depending on where you want to go. But that first step was always to demo trade and to see how you can do with that. One of the things that very early on, I really wish I would have said, I didn't say it until later, was that whole aspect of moving from demo into real money trading. Some people don't have a lot of money to do that with, but it's still equally important because there is a gigantic psychological shift between demo and real money, assuming that you're doing it right, and then maybe taking that step even further over to other people's money or whatever different direction you want to go. That real money stage is supremely important for so many reasons. I think, Rob, a lot of people get there either too quickly, like they rush it. I actually think that's what most people do. Or some people just demo trade forever. And no matter how good they are, they never feel like they're ready for the big time. We're going to go over that today. And Rob, what are your thoughts on that? You've seen it all, so you're the best person to ask here.
I don't know if I've seen it all, but I've seen a lot. Most people can learn how to make money on a demo account. Most people can. There's no question about it. And I've seen it firsthand, myself and everyone else. It's very hard to make money in the real market. Literally, the reason why we are having this Trading Psychology podcast is that this is part of the learning process. People think that they developed their system, they learned about the charts, they learned about all these Fibonacci sequences, and they think, I got it. No, you don't. That is like 10% of learning trading. There's a whole lot more to go, and you can't learn it without using real money.
100%. Because if you're going to trade real money, then you have to learn what it's like to trade with real money. So not only do you have to trade your own money to experience what that's like, it has to actually be a meaningful amount, or else it's pointless. There's a lot of nuances there in terms of timing and how much and all that. And that's what we are going to get into today.
And one thing that I found out just watching people, you have to understand that trading $2,000 is wildly different than trading $20,000. Trading $200,000 is wildly different than trading $20,000. Trading $2 million is wildly different. Now look, people say, look, they're just a zero. I'm making the same amount of trades. They shouldn't be any different whatsoever. Here's the reality. They are different. It absolutely is different trading a $2 million account than it is a $2,000 account. Totally different. You can't learn that step until you get there. So you literally have to go through all the steps. That's the way we structured Maverick, is that we start you with a little money, we give you a little bit more, we give you a little bit more, not because we're trying to slow anyone down, because that's literally part of the process to becoming a professional trader.
So Rob, let me throw you a curveball here. Yeah, I agree. Those things are different to me because my background and my income level, especially when I started out, was at a certain point. Some people's are much higher. Some people's are much lower. To some people, trading a $500 real money account is life and death. To other people, that's a Tuesday. What do you say to that effect? Is there a sliding scale people can deal with? I know that's a tough question. I don't always believe that trading a $200,000 account is really significant if you're just rich to begin with. Maybe that doesn't mean a whole lot to you.
The one thing I've learned in my life is money is relative. What I thought was a lot of money in the past, I don't think that today. What I think is a lot of money today, someone is laughing at me. They're saying that is nothing. It's all relative to where you are. And that's really the point of this podcast episode, is that when people get into trading, they learn the stuff, they get into demo, and then they make that jump. For some people, it's actually going to be a lot more intense. So for example, the person with $200 to their name, they put $200 on the line. That's going to be wildly different than the rich kid with super loaded parents that puts $200,000 on the line. It's a totally different experience. That's the point of this podcast, is to get everyone ready for that switch, because I'll tell you what, the rich kid is just going to have different problems. They're not going to have the same problems as a person with a little bit of money. They're going to have different problems. To understand that, to where you don't self-sabotage and get into this business the right way, is the purpose of this episode.
Good. And I'm glad you said that too, because we should be sensitive to that. I know it's a little bit off topic, but we always feel bad for people who were born poor, grew up poor, because they didn't choose that. That wasn't on them. Well, at the same time, that rich kid didn't choose that either. And there are a host of problems that come with stuff like that, especially the way they look at money. It's up to them to make money, but if they have a flawed concept of it, they're just as screwed as anybody else. So I'm glad you brought that up. In my opinion, and I want to see if yours match with mine, there are two main problems when it comes to the time when it is officially the moment that you need to be switching from demo trading to live trading. Let's talk about this first before we get down into numbers. When it comes to switching over to live money, give me your perspective. When do you think that's appropriate? What are some of the pitfalls that people run into when making that decision?
One of the answers to this question I've heard is when the trader feels they're ready. And that is wrong. That's just wrong.
No, wrong. So wrong.
And let me tell you why. Remember in one of my episodes, it was the episode we did on overtrading, and I talked about my overconfidence, how I was confident I could ride a motorcycle even though I'd never been on a motorcycle before.
Oh, yeah.
When someone tells me, hey, when you feel you're ready, go for it. Guess what? I'm ready now. I've never done it before, but I am absolutely ready now because I'm going to figure it out. The answer cannot be when you feel ready. We are going to have two groups of people that we're really dealing with here. People like me, who are very aggressive, who don't want to wait for the time. And then there's going to be a group of people that are hesitant and they actually wait too long. We cannot give the answer that it's time when you feel ready, because that is totally subjective to you and who you are as a person. So let's talk about the actual answer to this question.
Okay, good. Because I've seen it all just through my own YouTube comment section. That's usually the cross section that I deal with the most. I had so many people jump right into prop firms after learning my system for 3 months, which is insane. And I was like, well, congratulations. I wish you the best, but you're not going to make it. And then I've had some people that have been with me since 2018 who are still demo trading. Not because they're not doing well, they're doing well. They just don't want to pull that trigger. They don't, either they're very risk averse and this is what feels comfortable to them. I don't know. So if you have more clarity on this, I would really like to know.
I have a ton of clarity. Let's talk about just the facts, the numbers. Obviously, everyone needs to learn the business, develop a system, backtest the system, and backtest the system to where they get a decent set of numbers. All right, a decent set of numbers, that is a very subjective thing to say. Obviously, a profitable system is the minimum requirement, the absolute minimum. If you don't meet the minimum requirement of profitable when backtesting, you are definitely not ready to go.
Okay, so I think that's an obvious one. Yeah, if you're back testing and your system gives you a negative return, chances are you're only going to do worse. So okay, I've got my system together. I've back tested it. It looks great. Now I'm starting to demo on it. What do you think I need to do from there now?
Before you jump to the demo, there's one thing I want to talk about. This isn't going to apply to everybody, but I've seen this enough all my years of doing this. Depending on what period of time you chose, your backtesting results are going to be either good or bad based on the time period we chose. One of the things that always drives me crazy, and I'm probably going to offend some people here, but I don't care. I hate, especially with options, a lot of times I get all these option sellers, all these people that sell naked options. After the market has gone up for like 18 months in a row with really low volatility, I get all these people out of the woodworks being like, Rob, check out my numbers, check out my numbers. Okay, what do you do? Okay, I'm an option seller. I just sell naked puts. Okay, yes, you've been in the perfect environment for this strategy. But did you test it in 2008? No. Because guess what? You wouldn't have made it. I can look at your trading plan right now, and I can tell you this wouldn't have made it. You would not have survived this period. So why would I bring you aboard when I think that that could easily happen again, knowing that you're fully going to blow up an account? So you really have to go back a proper duration of time and be very thoughtful about it. Be very thoughtful about, let's take, if you have developed a trend following system, I need you to backtest that during a period of time where there was very little trend.
All right, so let's put a little finer point on that. As somebody who evaluates others for a prop firm, what kind of backtesting would you like to see for Forex, for example? The majority of people listening to this are Forex traders in some capacity. For trend traders, which is what we do on the channel, we have had, ever since my channel really started, 2018, 4 years of a very underperforming volume, followed by 2022, which was a lot better. Given those parameters, give somebody something to work with here. How far back would you like to see them backtest and during what years? Can they go maybe from 2020 to 2022, or would you like them to go further back?
One of the biggest misconceptions about the profession of a trader is we've seen all the movies, Wolf of Wall Street, Wall Street. That's not what it's like. What it's like is most of the work is done developing a system. You have to go back and be very thoughtful about how and when is this going to fail. And that's really what it is. If you have an engineer brain, and let's say you are like an electrical engineer, and you're designing this system, part of your job is to think about all the ways it could fail. If you're designing an electrical system, you have to say, what if a kid climbs over the fence? Now look, probably unlikely to happen, but what if they do? Okay, we need to now change our design in case this does happen to where we now have a fail-safe. Most of the work in becoming a trader is doing this kind of work. It's not clicking a button, slapping high fives and making money. It's in the trenches thinking about all the things that could happen. So basically, you need to troubleshoot your system and look at all the vulnerabilities to it and fix those in advance, because what happens is people take systems too fast into the market and then they find out, oh, it fails. A kid did climb over the fence. Oh, the Fed did this unexpectedly. And then the system fails. You've got to be really thoughtful about that. I don't have anything real concrete other than you really have to give a deep dive to your system.
All right, well, can you expand on that just a little bit? Because one thing you said triggered a bit of an alarm bell. I think a lot of people's systems, quote, failed when there was a rogue Fed meeting that went the opposite way of what people thought. When you say fail, how long of a duration do you think that has to take for us to say, okay, this system has failed in this particular circumstance?
That is a great question. Failure is a relative term because it really is about one or two things. Number one is drawdown. How much of a drawdown did it create? Now, if it created a 15, 20, maybe even 25% drawdown, okay, you know what? Someone can recover from that. Did it produce a 50, 75, 80% drawdown? You can't recover from that. It's really about the depth and the duration of the drawdown, much more so than anything else.
Okay, so that's actually a really good answer because on my channel, I give people kind of a guideline of what to avoid in terms of maximum drawdown. So this is really good to also hear this from somebody who runs a prop firm. It's okay to have different numbers here because it just kind of depends on what you're doing and which direction you're headed. We don't throw actual numbers out here because this is more psychology than it is money management. Yeah, good to know that, what I say is sometimes different from the requirements an actual prop firm might have because you guys all have different ones. So that's a good way to do it because you're right. Yeah, if you're sitting there trying to find out like where all the fail points were, you'll be doing this forever. So using actual numbers like that, I think that's the actionable play. Yeah, I really like those points. That's something everybody can really use. But then once you're done with that, you still have to forward test on demo. I've always thought that was non-negotiable. Don't just jump right into regular money. What are your thoughts on that, Rob? And you've probably already heard everything I've had to say about forward testing. What can you add, or what would you change to any of that?
I'm going to give you an answer that really surprises you and others. 2 months.
2 months. That does surprise me. That's very low. Why do you say that?
Because everything we just talked about, until there's real money in the line, you're not really learning anything. What you need to learn in the demo period is how to execute an order, how to put in your order correctly, how to change it, how to manage the stop, how to do these things. Other than that, you're not really learning anything. You're not learning anything about the actual business of trading. So you have to learn how to do the mechanics of it. How do I identify a signal? How do I put in the order? How do I execute the order? How do I put in my stop? How do I manage my stop? How do I manage my trade? That doesn't take a lot of time to learn. You have to get to the money part before you really start to learn about trading.
Okay, so this is good. Like you and I have pretty much agreed almost in lockstep on everything for 11 episodes. I'm glad we have a little bit of a difference here. Hear me out on this, and maybe I'm not understanding this correctly. So I've always said to go longer because what if during those 2 months was just a period of absolutely no volatility or a period of wild volatility? We've all seen 2 month spans where that has happened. I say go longer so you can experience more market conditions and get used to how to trade those. But what I think you're saying is yeah, you're still going to do that. You're just not going to do it on demo. You're going to do a lot of that actually trading real money and getting yourself in that game a lot sooner. Am I close here?
Yes, and let me give my previous with a small amount of real money.
Well, how small? Because if I'm trading $100, that doesn't mean anything to me, and I'm not going to trade it like real money. I'm pretty much going to trade $100 like I would a demo account. So, like, what are we talking about here?
Great question. We talked about how money is relative. So I'm going to go back to the Yates Dodson Law. There's something called the Yates Dodson Law, which is basically a graph that basically maps out for us in humans where the optimum level of performance is made. If you risk too little, so let's say that you are fairly loaded and you decide I'm going to start out with $200. Guess what? You're not going to make it. It's not even remotely interesting enough to you. However, let's say that you only have $200 and you start with $200. That is way too intense. That's so intense that you're never going to manage it as well. I wish I could give you the right number, but it's all relative to where you are with your situation. So for some people, it may be $200. For some people, it may be $2,000. It might be $20,000. But look at this chart of the Yates Dodson Law. If you are listening to this on Spotify or another podcast, just simply Google Yates Dodson Law. Look at the chart. There is a point where you have the optimum level of stress, but not too much stress. You need to find that level. I wish I could give everyone a hard number. You've got to really figure this out for yourself.
Okay, good. And we will link you to that very study down below in the description if you'd like to take a look at it. And that's good. I'm glad you didn't give a hard number because like you said, this is a very nuanced thing. But I would just say it has to be an amount of money that's not going to break you if you absolutely lose it, because we don't want anybody, having a financial hardship here. But it still has to be enough to actually mean something to you to where you really don't want to lose it. If you did, that might actually set you back a little bit, because in real life, that's probably going to be what you're dealing with. Is this fair to say?
I think it's healthy for everyone to go into their first account with the expectation that they're not going to make it big and that they're likely going to lose a portion of it, at least, if not a significant portion. I think you have to go into your first account with that expectation. If you're wrong, I'll slap you high five and say great job, but I think it's a very healthy place to be.
Okay, good. I had this in my notes. I meant to bring this up earlier, but I didn't. But I think a really good actionable thing you can do in the forward testing stage, whether this is demo or real money. We spoke, and you can go back and just kind of type in to my channel the word journal. I did a whole old podcast episode on how to set up a really great journal. I said the most important column in that journal, journals are spreadsheets to me, is the comments section, where you're going to write down where you went wrong, assuming you made a mistake not following your system to the letter. I would say as far as when to pull the trigger would be when you have absolutely minimized the amount of comments in your journal, because that says you're actually doing what you're supposed to be doing. And that's a really good thing. If you can show that you can trade a system that has been proven to work, you're probably pretty close to ready, in all honesty.
I'm going to come in with an even more definitive answer. Look, there's been a lot of ambiguity in this episode. What we've talked about, hey, it's really based on you and your money levels. But look, there are two hard answers here. Number one, if your backtesting doesn't produce a profit, you aren't ready. You cannot go any further. Here's the second definitive. If you're still screwing up on a demo account with not following your system, you cannot go to live money. If you even have one time out of 10 where you did something you shouldn't and it's just demo, you are in a lot of trouble when you get into the live market with live emotions. So for me, those are two hard lines. Number one, you have a system that produced profitability in the backtesting. And number two, you don't screw things up in your demo. That's a hard line for me.
And I think that's great when you said 1 out of 10. I mean, traders, do you have any idea what taking one unnecessary loss out of 10 does to your bottom line? I mean, do the math. It's extraordinary. I think that's a really good guideline to go by. Rob, anything else you want to add to this? I know we've been a bit all over the place, but I think we ended up in a pretty actionable and easy to understand place, which is good, because this is just one of those topics that it's not super black and white, but there are very black and white things you can do.
We need to talk about account size. For any of you that play poker, there is a certain amount of money that you need to have in your bankroll in order for you to sit down at a poker table. Now look, anyone can sit down at a poker table. I could have $20 in my pocket. I could have $200. Anyone is allowed to sit down at a poker table. Anyone is allowed to put money in and to trade the financial markets. Anyone. However, if you really want to learn poker properly and play poker properly, you need to have a certain amount of hands in your bankroll so you can sit through long streaks to where you lose money. You have to have that, or else, statistically speaking, you're very unlikely to win at that table because you don't have a big enough bankroll. Trading is the same way. In our Dealing with Slumps video, I gave everyone a download that they could download. If you don't have it, go to maverickcurrencies.com/odds. Download our chart of the odds of you having consecutive losses in a row. You need to be able to survive these. So you've got your back testing, you've got that chart. You basically have to get enough money together to where you can actually sit through those drawdowns. One of the things we talked about is go back into your back testing and see the worst period of time. What was the worst period of time that you had in the back testing? Apply it to trading today and see if you could survive that. If you can't, you need more money. You need more money, or you need to change something up. Account size is really a big deal when you start out, because if you don't have enough money to weather the drawdowns that are statistically guaranteed to happen, not to mention the emotional mistakes you're likely to make in your first go around, you are guaranteed mathematically to lose. It's not even about you didn't have enough information or data or intelligence. It wasn't about that at all. It was just math, and that's why you lost.
That's really interesting. Maybe $200 is a lot of money to you. I'm certainly in no place to judge. The problem with that is you're going to have a really hard time practicing proper money management, because sometimes micro lots just don't go low enough in certain situations. So you're probably going to need more than that. Again, we don't like to give numbers here, but all I can say is if the amount you're putting in doesn't allow you to trade like you're supposed to trade with real discipline and real account sizes, then you're just simply going to need more. I'm sorry, I don't make the rules. That's really all I would have to add to that. But there's something else we spoke about in an episode not long ago that can also alleviate a lot of this in a way, but is something, and for that reason, I think is something you should probably have or start working towards before you go live, or even really before you decide to join a prop firm, especially. And that's going to be having those multiple income streams as well. What are your thoughts on that? I almost think that's a prerequisite.
One of my sayings over the years has always been, you need to trade for the sake of trading. Having other income sources allows you to have the freedom of trading when the setup is correct. Having these other income streams coming in or having other monies to where you can actually make no money for 3 months is going to put you in a situation in trading where you can then trade for the sake of trading, meaning just trade because the market is there and the market is giving you a good setup and it fits all of your rules. Anytime you're put in a situation where you have to make a trade for another reason, you have to make your rent, or you're bored, or you lost a lot of money last time and now you got to make it back. Anytime you put yourself in that situation, it's really tough. I don't want to say it's impossible, but I'm going to say it's almost impossible to make it, because trading is hard enough to just get good trading numbers. Then you throw on all of those minefields of psychology problems. It's going to be very, very difficult. So build those other income streams. Think about what you can do to where your trading isn't going to pay the bills. It's just going to grow and grow and grow.
Okay, good. Because I know I was taking a bit of a risk bringing that up, but all I can say is if I owned a prop firm, I don't want people coming in trading desperate. You better have your act together in that regard. So that's a good one too, in terms of when to actually make the jump. Don't make the jump because this is an all or nothing proposition and you're going to live and die based on your results. Make sure you're in a good place first. And that's tough because a lot of us aren't, we started out, we weren't in a good place and we trade so we can get out of it. But yeah, don't come into a prop firm with any level of present or future desperation, because that's not good for anybody. That's not good for you. That's not good for the firm. That's bad for everybody. And having multiple income streams does go a long way in alleviating that burden.
One of my favorite questions to ask people whenever they're having a hard time making a decision or they don't know what to do, I always say this. Imagine your best friend who you deeply care for and love. Your best friend came to you and said, hey, I'm thinking about doing this. What do you think? Whatever advice you would give that person is the advice that you should give yourself. And it's funny because I'll even use this on small stuff, like someone says, oh, I think I might want to buy Tesla. Okay, imagine your best friend is wanting to buy Tesla right now. What would you tell them? All of a sudden they're like, you know what? I think I'd tell them to wait a little bit. I think I'd tell them to do a little bit of this or buy a little bit today and then maybe buy a little bit more later. All of a sudden, their answer changes to what they would actually do, because now it's external. You are now having to put yourself out and give advice to someone else, and that advice might hurt them. So you're very, very delicate. I would really recommend you go through that exercise and think to yourself, okay, if my best, dearest friend came to me and said, hey, I'm ready to go from demo trading to live trading, what do you think? The advice that you'd give your dearest best friend is exactly the answer to this question.
What if I secretly hate my best friend?
Well, then that's not a best friend.
Yeah, that's true. Okay. Well, good. Well, on that note, we'll go ahead and wrap this episode up. I hope you got a lot of actionable advice out of it. Depending on where you are in your trading journey, this might have been just the things. Thank you for listening to episode 12. This is VP, and I will see you next week.
Goodbye, everybody.